Alex Blackwood, and with me always is Joey Gumataotao, co-founders of Mogul. And so, we can jump just right into this right off the bat.
Yeah, let's do it.
So, if you wanted to just give a brief background about, because I know some people out there know who we are, but at the same time, short attention spans,
Yes.
all of the above. So why is it that you started this, who you are, a little bit of background about yourself?
Yeah, and also never hurts to go back through the old background story. I know we probably have some new viewers too that weren't tuned in the past couple of weeks, so welcome. If this is your first time, episode 3 of Ask Mogul Anything. We'll be here every single week, Fridays, same 1 p.m. ET. Super excited to be back. So with that, yeah, just my name is Joey Gumataotao, co-founder with Alex here. We've been working on Mogul for a few years now, but have really only been live for basically the past year and a half, right? Is that about right?
Yeah.
So it's been a crazy journey, just from originally kind of starting this and ideating on it while we were still at Goldman Sachs. Just as a little bit of background, joined that team in the real estate private equity group within the merchant bank practice right out of school. So went to school at Harvard in Boston, played some tennis, studied economics there, and did the whole investment banking recruiting junior year. Ended up choosing Goldman as my destination. Did the summer internship there, which we all remember our summer internships in the finance world. I know a lot of my peers at school remember those as well. And then joined the team full-time after school. So was there for about 2 years, going into my senior associate role, leading deal teams, investing kind of capital from Goldman Sachs balance sheet, as well as third-party managed funds up and down the capital stack, both credit and equity, across a pretty wide array of product types. Like, so think multifamily, office, hospitality, which Alex has specialized in, and a couple other cool verticals like single family rentals. Hint, why we're here at Mogul today, focusing on that product, and then also glamping, which Alex specialized in as well. But Alex and I met about 2.5 years into my role there, and Alex will kind of explain his background and how we crossed paths that way. But immediately kicked it off, right? The famous story is that you invited me to a diner out of the blue after we had played some tennis for the first time. And I was kind of like, didn't know what to expect. You had mentioned that you had been working on a couple entrepreneurial ventures on the side. You had your realtor's license. I had done a bunch of realtors training and had been working with a brokerage at the time, helping out on some listings and sales, investment sales. And so with that, we went to the diner. It was like the middle of summer, like June, was it?
It's hot as shit.
It was hot. That's all I remember. All I remember is it was hot. There was ice in our orange juice because it was that hot. And we spent like a solid 6 to 8 hours in there just ideating after what was supposed to be just a 30-minute, post tennis brunch. And, 8 hours later, I was fully committed and locked into the idea of starting a kind of direct access real estate platform powered by the blockchain that we would then market out to any and all investors, creating kind of a, we like to stray away from the word, but really democratized real estate product that had access and transparency for all. And so with that, pass it off to you, give some of your background, how we met and everything.
Yeah, I can just run through briefly, but for those of you who don't know, obviously met Joey out in the Dallas office, but had a pretty wide tour of Goldman's office, even during the pandemic. So I was in New York in their investment banking division, where I worked with financial institutions group and banks, specialty finance, insurance, fintech, asset management, all the above, which was an incredible opportunity. Got to learn pretty much hands-on what drives these massive financial institutions. And then was in their tech media telecom group out of their San Francisco office, but based in New York, pulling investment banking hours cross coast, which was
classic.
Very fun. But with that, I moved out to the Dallas real estate private equity group where I met Joey, and we just hit it off. We connected. I joke all the time. He's the wunderkind of residential, but it's true. I asked who here invests in single family rentals, and everyone pointed me to Joey, not just our peers, but MDs, partners alike. And so when I called him to ask him to meet me in the diner, it wasn't a haphazard, let me just pitch him on this idea. It was a cold, calculated, I want him on my team or this doesn't happen. And so with that diner meeting changed us all. But one of the things that I'm very curious about is obviously you had your pick of the litter. You could have gone into whatever industry you wanted to go into. Why did you choose real estate? What about this asset class is boiling in your veins to the point where you can't go to bed without thinking about real estate? Why?
Yeah, I mean, that's a great question. I think something that we ask ourselves all the time, you and I, and we talk about a lot. But I think one of the things that we really love about real estate, I particularly love about real estate, is it's a private market asset, right? With direct access, direct control over operational outcomes. You have a decent sense of capital markets, when it comes to pricing and cost of capital, controlling sales outcomes relatively. Like no sales outcome for real estate is clean. We know that transactions can be super messy, hence why we like to offer you the cleanest and smoothest and easiest way to invest in real estate, because it is an absolute headache closing transactions. There's always hiccups here and there. It really takes experience and knowledge and preparation to be able to get through any closing, whether you're purchasing or selling. But on that point, what I'm trying to get to is essentially I love the way that you can kind of buy, grow, sell model, right? Like typical private equity model is essentially we can go out, take a lot of market research that's not necessarily subject to as much public speculation as, securities or stocks, your classic value based off of, speculative, right? Kind of aspects of it. And so with that being said, love the idea of finding a great basis, right? We love amazing bases at the front. We love buying things at a discount, creating value day one, levering it up for that, levered return on that multiple on your equity, controlling operational outcomes, optimizing, doing the market research to make sure that the fundamentals make sense, make sure that the comps can essentially justify every decision that you're making from a rental perspective, control the timelines, right? Controlling whether it's, 3, 5, 7, 10-year holds in the world of real estate, although soon fully liquid with Mogul. And essentially I love the way that you can kind of, drive outcomes, right? I mean, no investment is going to be perfect. There's always going to be roadblocks, but you can come to the table prepared. You can do your market research, and every decision you make, in my opinion, in the world of real estate can be justified in some form or fashion, right? By diligence, by research, by preparation. I don't think anyone could safely say that you can do that as consistently in public markets. Let me know if you agree with that.
I mean, yeah, it's entirely true. Well, because also when you speculate about a stock, it's like, all right, I don't know anything about that stock, right? It's like you read a 10K, maybe you read a 10Q, maybe you read whatever filing is out there, but at the same time, your guess is as good as any on what that stock will do. And it's public speculation as to what that valuation would be. Now with real estate, obviously, given its brick and mortar asset and the true value inherent with real estate, that's where the value comes in. That's where the value can be driven from. And so, I mean, right off the gate, I think we should just jump into, and I can handle this one, is what exactly does Mogul do? And it's pretty simple model. We buy real estate and then we offer equity in that real estate out to our end users, starting at $250. So you want to get your feet wet in real estate. You don't exactly know why it is that real estate is a returning asset or how it earns or returns the way it does.
Right.
You can earn while you learn. I joke, but I'm a hands-on learning model. I like to see and feel and actually understand what it is that I'm investing in.
Yeah.
And so with this, you can treat it kind of like an interest-bearing savings account where you're setting aside a little bit of cash each month, maybe $250 each month, just to receive a little bit of yield on it. And so you're buying fractional ownership in high-quality residential assets starting at $250, and all of the property management is done by a professional, a licensed professional. We go out, we source the best properties out there. We bring them into our inventory partners, and then from there, just grow as you go. And I guess that's kind of a high-level overview, but tagline is buy shares and own.
Yeah, 100%.
As simple as that. So with that, I'd love to talk a little bit more too about, I mean, what markets are the ones that you see the most potential? What are the growth levers there?
Yeah.
What are the dynamics at play when you look into them that you think are going to give you the highest outcome possible?
Yeah, no, I'd love your opinion on this too. But the typical buzzword, right, in the past year, 2 years, especially in the world of residential, single family, and both multifamily as well, is been, Sun Belt, right? It's like tired of hearing the word Sun Belt. really what it is just focusing on high growth secondary markets located in pretty strategic areas across the US, usually where a lot of in-migration is happening, from states like, unfortunately right now, like California, a lot of East Coast states where people are migrating out of these primary cities where the cost of living is super expensive. And you can probably get arguably the exact same quality of life in some of these secondary high growth cities. Note Austin, the Dallases of the world, Atlanta's, Nashville's, right? Very hot markets right now, especially from a real estate perspective. And we all know that real estate follows trends of population flow, right? So when people are migrating in from California to Austin, Texas, for example, which is definitely something that's been happening over the past few years and continues to happen now, real estate prices will obviously appreciate, right? Which will increase levered returns for any investors that are exposed in that market. So one of the things that we're focused on now is targeting these high growth secondary markets that haven't topped out, aren't supply constrained, and still have a lot of opportunity for growth, right? And those can be found anywhere, really. Like you can find them within primary states, including California. We have obviously the Ukiah property out there, the Logan. Go check that one out. That one's going to start cash flowing next month. That one's going to be great. Beautiful kind of villa style property. It's massive. That one had a cost basis of around $950,000. Nice big deal, very yieldy on a short-term rental model. But that's just a great example of smaller pockets that you can find, right? Like that one's out kind of in what we call the Inland Empire. Still experiencing a lot of top-end growth. Fundamentals look great. It's really focusing on these high-growth secondary markets that still have room for growth and haven't topped out in supply. And so that, markets that are kind of correcting now, right? You see places like Phoenix, Arizona, and a lot of kind of markets in Florida and around like Miami and other places that I would argue are very supply constrained at this point, especially when it comes to residential real estate. A lot of, you'll see like Airbnb, Verbo model out there. It's like there's almost more homes than there are people willing to rent those homes at this point. Driving rental yields down, driving rent prices down, per night or per week or per month. And then inherently that's going to drive real estate prices down, right? Capital markets and real estate is very much tied with operations. Operations very much tied with capital markets. Yield requirements on top of purchase prices and bases in the world of real estate is super important. And if you want to go check out some of our blogs, we do talk about that pretty in depth. But yeah, that's just my 2 cents. I'm curious if you have your own opinions about that.
Yeah, I mean, I always have.
Yeah.
But obviously, anyone just joining us, feel free to leave a question in the comments section, both on LinkedIn and YouTube. We're live across both right now.
Yes.
So, I mean, one of the things that you touched on a little bit is the capital markets constraint. And so I'd love to dive into one of the questions we get all the time is, interest rates being what they are, why are you still investing in real estate? And it's this vicious cycle right now that we're in that honestly is one of the first of its kind, that interest rates were so low for so long. And what that does is that increases the buying power of an individual. You and I could have bought a lot higher value of a property, a lot bigger a property. Now, in buying that doesn't mean that we necessarily should have, but we did. And so we locked ourselves down in these 30-year contracts with lower interest rates over the past few years when home values were at its peak, were at the highest that they've ever been. Now, over this past year or year and a half or so, interest rates have risen. Mm-hmm. When the interest rates have risen, that's decreased buying power.
Right.
What does that do? Demand goes down as a result of that because people don't want to come into the market and buy and lock themselves into a higher interest rate than was in the past little bit. Now, when that happens and it locks you in for a long haul, sellers don't want to sell either, because why would you sell to a market that doesn't want to buy what you're putting out there?
Right.
And so with that, it creates this vicious cycle where would-be sellers aren't selling at all. Supply is constrained, as you just mentioned, mm-hmm. and no one's looking to buy, but the people that are looking to buy are pushing that price artificially even higher.
Right.
So that ceiling is getting pushed up, but interest rates aren't coming down just yet. So that means that this supply is still at the prices that were in the lower interest rate environment, which ultimately leads to higher prices.
Right.
And so that's kind of the vicious cycle that we're in, but there's always value to be had. There's always opportunity to be had in those secondary markets with massive growth dynamics. Companies are still growing, employment's still growing. That means that markets will still continue to do well, even in this environment. And I'd argue even better, in this environment because the appreciation will come artificially with a lower supply. Now, that's the market opportunity we see. Even with interest rates that we have, we're able to source those deals off market, pre-market, whatever they might be, and return 17% plus IRRs.
100% agree. I think that's a great segue too into one of the questions that's really important that we get asked a lot, but also is I think you have a great answer to, is with interest rates obviously having increased because of a lot of our artificial swings in the cycle over the past couple of years, and the cost of capital being relatively high, obviously in response to inflation being so high, right? Which means if I have, $10,000 right now, that's only all the more confusing as to like where I should allocate that, right? If I have $10,000 in savings sitting in my savings account, like what the heck am I supposed to do with that? Like how much of that should go into the stock market? How much of that should go into real estate? No one thinks about that. Like at least I used to not think about that until I started getting involved in real estate myself. And it's like, where the heck am I going to put it? Like, what do you think?
I just want to preface this with, this is not financial advice by any stretch of the means. This is only the advice of the Yale economics CIO.
Yeah.
And really it comes down to the individual. And so you and I were at the highest earnings potential of our career, right? Mm-hmm. Because we're early on in our career.
Right.
Now, that means that we can be a little bit more risk tolerant, I would say. So you would skew more risky assets.
Right.
So you'd skew towards the stocks that fluctuate in value like crazy. You'd skew towards things like real estate that still have stable returning assets, but a higher return.
Right.
And because you can hold on for longer. Now, the short answer is this Yale economic professor and CIO endowment chair says 20% of your portfolio should be allocated towards real estate. What is this based on? He had a theory that the traditional stock bond portfolio mix of 60-40 should be actually 50% stocks, 30% bonds, 20% real estate. He took over the Yale endowment in 1985. In that year, when he took it over, they outperformed every single endowment to date till 2021 when his reign was over, I would say, by an incredible margin. And it's been dubbed the Yale method, and every endowment has taken this over. Now, does this mean this portfolio allocation strategy is right for you? I can't give comment to that.
Right.
But I would say for the Yale method and the one that endowments have followed to date, 20% of your portfolio is allocated to real estate. So to answer your question, with your $10,000, $2,000 in real estate would be the Yale method allocation towards real estate. Now, Joe, you talk a lot about this, and I'm very curious because I haven't heard it put so eloquently, but how do you treat mogul? Like, how should you approach it? Should you think it's like a one and done type scenario?
Right.
How do you deploy capital at scale in these properties? So how do you think about your account with mogul?
Yeah, I mean, the way that I treat it and the way that I try to, when people ask me how they should treat it and think about it, is I really use it as my savings account, honestly. Like essentially I set aside a certain allocation of, my income, right, every month that I'm obviously not using to pay my bills, my rent, my mortgage, whatever it is. And, part of that is going to be usually going into just a savings account, right? And I don't know what your interest rate on your savings account right now, but mine's crap. Mine's like whatever, 2%. That's probably like a pretty high yielding savings account, right now. Like sometimes you can get that weird, 3-4% deal, at some places. Yeah, you lock it in. There's always caveats.
Some contract, sell your soul to the devil.
Exactly. That's in the fine print. Quite literally.
Terms of service. No one reads it. Exactly. It's very important.
Exactly. Where was I? So yeah, sorry. Essentially, the way I like to treat mogul, and the way I would recommend when people ask me, again, this is not financial advice. When people ask me, what do I say? How do I treat mogul? I say I use it as my savings account. Right, because if I am going to be achieving, say that 2% in my savings account, why would I want to keep a large chunk of change in there just sitting, not even beating inflation, when I can have it in something that's relatively a higher cost of capital? When I say cost of capital, I actually mean a return of capital, right? It's all about the perspective. So for me, if I'm going to think about investing, let's just say, for example, in what you said, if I had $10,000 and I was putting $2,000 of that into my savings account, well, I might as well just put that into real estate, because the cost of capital for real estate, especially what we're achieving, I've already achieved on Mogul's platform, and real estate is very capable of achieving, call it in like, the 10 to 12% plus range. It's like, why would I not reap that yield every year and, make $200 on my $2,000 every year instead of making 1 to 2% on that $2,000? It's like, it seems a little bit like just a relative cost of capital example that we always talk about. And I think one of the things that people should think about is, why would they, again, have their money sitting in a place where it's not going to be returning the capital that they would need to beat inflation and beat other relative costs of capital, when you can put it in something like Mogul? I like to treat it like my savings account. So anyway, I put my savings in my Mogul account every month, just like I would a savings account. It gets invested in the real estate. It starts earning yield right away. It will be liquid soon, and we will be able to facilitate sales of it and actually achieve return of capital on it as well on the appreciation side. And so I think it's just a great place to, park money on the private side, right? It's like, I could have it in stocks, I could have it in bonds, but like, it's like you said, so much speculation. It's all relative risk. So yeah, curious to hear your thought.
No, I mean, I completely agree with it.
Yeah.
It's all about, when people look at their portfolio, they should be looking at it in terms of what's the opportunity cost of that?
Right.
Like, if I put this money to work in this asset class, what happens?
Right.
And you should be thinking about it in the long term, but you should also be thinking about it in, what are your financial goals?
Mm-hmm.
Do you want to be retired by the time you're 50, 60, 70, whatever it might be, and back into what that portfolio allocation should be today?
Mm-hmm.
Because for us, it's going to be a lot higher of a potential risk in terms of just investing across a wider variety of assets.
Right.
But at the same time, there's also a higher potential for a higher returning asset in the long run that you mitigate against because you have a longer time horizon.
Right.
Now, I completely agree with you. But I would also say that real estate is an incredible asset class, because you kind of get the benefit of stocks and bonds.
Yeah.
You get an interest payment payout that's a high yielding asset of 10% in some of our cases on platform. But on top of that, you get the appreciation that goes with it.
Mm-hmm.
And you're investing in an asset class that facilitates life. I mean, it's a necessity of life. You talk about shelter, water, food.
Yep.
It's one of the first ones that is mentioned. And so I think it's just an incredible asset class to be invested in, because you get that equity upside, but you also get the cash flow from that.
100% agree. I mean, can you just maybe like walk us through what that appreciation looks like, too, like on $100 home, for example, like just for easy math?
Yeah. So $100 home. Are you talking about appreciation or cash flow? Just appreciation.
Yeah, just because I think we all relatively talk through how the yield works, right, on operations, like I kind of mentioned earlier. So like, when you're thinking about the leverage, right, assuming that you take out a mortgage on the property, which we do on all of our properties on platform, why would we do that? And like, how does the appreciation work in terms of like how much we would get if we did or didn't take out the mortgage? You know what I mean?
Yeah, no, I completely understand. So leverage is a pretty interesting thing when it comes to real estate, because when you're investing in a property and you take out a loan on that property, it's a long-term loan. It can be a 30-year fixed mortgage.
Right.
And so you're locking in an interest rate, but inflation continues to increase. But if we're talking about this strictly from an appreciation perspective, when you take out that loan, that means you have to put less down day one. And so an LTV is a loan to value. And so at that $100 home, if we were to use this as an example, if you were to say put down 80% loan to value, that means $80 of the $100 would be coming from some lender.
Yep.
Now you only have to put down $20.
Right.
Now what happens to the home price over time? Now let's say next year, for whatever reason, that 100 becomes 110 because that's the purchase price increase, a 10% increase. Now, if you had bought that without any leverage, you would have put down a full $100 and you would have gotten 110 back, which means that you would have gotten a 10% return. That sounds great in theory. But when you look at it from a levered perspective,
right,
you put down 20, the loan that's due when you sell that home is only 80. It's stuck at that amount. It doesn't get any of the upside.
Right.
Now that 10% appreciation comes and it's $10.
Right.
Because it's at 110.
Right.
$10 over your equity basis of 20, 50% return.
Yep.
So that 10% now becomes 50% and just highlights the absolute power of leverage. Now everyone thinks, oh, but where is the rest of my capital?
Mm-hmm.
Invest it in other homes.
Right.
You can put $20 in each home, and you can put $20 in 5 homes and achieve 50% on that, which $150 you're going to get back as opposed to $110.
Exactly.
And so that's just obviously a little bit of leverage in a nutshell.
Yeah.
But it's a weird phenomenon, and it's hard for people to wrap their head around because everyone's like, oh, I just want cash flow today, but it's like appreciation is the real winner.
Mm-hmm.
That's where you drive a majority of your returns in real estate, even though you're getting cash flow day one.
100%. And just as a quick recap on the cash flow too, it's like that APR you mentioned, that interest rate that you negotiate with your lender, if that's a fixed rate that you're locking in for 30 years, that's not changing, right? So it's like your yield on your real estate ideally is growing. You know, we have a net income yield growth post expenses on the properties on the platform of an average of about 3 to 3.2% right now, growing per year. And so with that growing, right, that's day one, it's at a certain spread over what that pre-negotiated interest rate is that's due to that lender. Say it's like 5% and you're making 7.5% after expenses on your real estate, or 10% for ease. You're pocketing that additional 5% of yield, you know what I mean, in your pocket, right? And so that's the other piece of that return that you're getting is that yield. And you've already paid off that pre-negotiated return for your lender. So as Alex said, that appreciation that you're getting, that's straight to your pocket, assuming the model that we just talked through, the $100 home with the $10 of appreciation going straight towards your $20 of equity invested, 50% return, as Alex mentioned. So it's like paying off that pre-negotiated return with operations is super important. And any additional yield that you get on top of that is just gravy. I mean, really, it's just operational gravy to your pocket on top of that massive return of equity from that appreciation.
Yeah, I couldn't have said it better. But
you did.
I will. I think the next question that's always asked, and by the way, if you're just joining us, feel free to leave a question in the comment section on both LinkedIn or YouTube Live, where we're live across both right now.
Yeah.
But I think one of the questions that a lot of people always ask is, why should I invest in your platform versus, let's say, Fundrise or any of the other Fundrise, Fintor, Arrived Homes? Why is your platform the platform that I should allocate my dollars towards at the end of the day?
Yeah.
And so go for it.
Oh yeah, sure. Right. I mean,
off the rip.
Yeah, off the rip. I'm happy to take it. I mean, I could speak for days about this. There's a million reasons why it's just objectively better for you to do a direct investment. And I'll let Alex talk through just some of the true changes that we have that kind of differentiate us from other platforms, aside from obviously the stellar team that we have here. But, platform and product, right? It's like, what's the difference there? The product that we're offering to our users is direct investments into real estate via these investment clubs, right? Via these mogul clubs. And so what does that mean, right? You could go out and invest in a syndicate, in a REIT, in several different types of fund structures, special purpose vehicles that are essentially dedicated towards allocating your dollars in a more passive style, right? Via those funds into real estate where you don't have a say. You get kind of scraped in terms of fees, right? Usually there's an asset management fee, right? Not atypical for that to be 2.5%, sometimes upwards, right? Per year on your equity invested. And not only that, tax benefits, no guarantees there depending on the structure. And also some of the governance decisions, right? Like I said, a lot of the benefits of owning and operating private assets, especially real estate, is that you have direct relative control over outcomes when it comes to operations and capital markets and sales. So what does that mean when it comes to mogul? We offer those direct facilitated investments into these real estate assets. You are the boss. You have a say in your governance structures according to what happens on the operational side, what happens on the capital market side, according to your pro rata ownership. So it's like how much you own compared to everyone else, right? You'll have that prorated vote in that operational outcome of the real estate. You get the tax benefits at the end of the year via your tax documents portal on the mogul platform. And none of the net return that we're making is pocketed by us. All of the fees that we charge for facilitating the service are capitalized in the deal when it's put on the platform. So that net 17% return you're seeing, that already takes into account any upfront fees that had to be capitalized just for propping the property up on the platform. The great part about that is we're not taking away from your direct return via, again, those asset management fees that come straight off the bottom line. We're not taking away from your tax benefits. Those are direct pass-through entities via these mogul clubs that you get to experience all of directly. And you get a say. Like, it's at the end of the day, it's like, do you want to control your investment? Do you want to empower yourself to actually be a homeowner, even if it's in a fractional sense? I would much prefer that over passive style fund investing where you have zero say and zero control and zero transparency most of the time. Like, it's like you said, Alex, like no one reads terms of service. No one really reads all the fine print. And it's like, I've even been victim, and I would like to think that we're decently literate when it comes to financials. I've been victim of hidden fees all the time. We're victims of it every day in everything we do. So the greatest part is like freemiums, the freemiums, the hidden fees. So it's just like you don't want to run into that, especially when you're trying to make a return on something, right? When you're trying to think about how much return you can generate per year from a private investment, you never want to have that happen where you're getting scraped for those fees in real estate. So that's one of the many reasons why the model that we facilitate on the mogul platform is beneficial compared to a lot of our peers, kind of REIT style investing, syndicate investing. So, maybe in a second or two, you can talk about some of the platform benefits as well. I know you've been working really hard behind the scenes to release some new cool changes and a lot of cool stuff in the works in terms of the pipeline. And so maybe if you want to just talk through kind of some of the cool stuff coming through the pipe, what's different now on the platform versus other platforms.
Yeah. No, our camera got disconnected for a second there. Bear with us on the technical difficulties side. But to be honest with you, I like to share this anecdote whenever I get asked about why you'd invest in real estate through us versus some other platform. And it came down to a few years ago when we were kind of throwing around this idea and it first came about. I was buying my first property and I went to my friend. I was like, I'm going to buy my first single family rental home. I want to do it out of Dallas. This is how I'm going to do it. And my friend, he was in real estate investing himself, he said, why on earth wouldn't you just invest in Fundrise? Like, why would you deal with any of the headache? Why wouldn't you just go completely passive with it? Throw your money into real estate if you truly want exposure to that asset class. And ultimately, it came down to the fact that their returns aren't real estate returns.
Right.
It's like, it's not an attractive asset when you're returning 5%. And that's what Fundrise does.
Right.
Or any of the other platforms, not to name, obviously, Fundrise right out of the gate. But any other platforms are returning pretty low percentages, low teens, maybe if you're lucky, but kind of around that 7 to 10% range. I mean, for us, our hurdle rate is 12%. We've seen deals in the 11% IRR range, and we've said, no, that's ridiculous.
Painful.
That's not what we do here at Mogul. I mean, when we were at Goldman, we were investing in assets that were high teens returning. And that was something that would go through our investment committee. And there were a lot that petered out. And so with us, it's approaching the same way that we did at Goldman with the high teens returning IRRs. Average IRR on the platform right now is 17% plus, yields around 9%. I mean, Roman is about to yield a ridiculous amount this month alone. And this is true real estate investing. Like, had I had this back in the day, I don't think I would have bought my single family rental. I would have been like, all right, here's the investment that I'm going to put my money towards. Here's where I'm going to invest in real estate, because this is an actual real estate investment at the end of the day.
100%. I mean, I wish I would have had this 5 years ago. I mean, think about when we would get our, bonus seasons and everything, and we would just have that, sitting in a savings account for a little bit, or like put into our brokerage accounts in the stock market. It's like, I really wish I would have had this.
Yeah.
That's why we also built it. So.
Yeah. So, I mean, I think that touches on pretty in depth as to kind of why us against any of the other platforms out there. But I mean, if we're thinking about it, and if you're just joining us now, obviously, just feel free to throw in a question into the comment section below, or hit subscribe to if you're on YouTube Live, or if you're on LinkedIn, obviously follow us on LinkedIn. But I guess when you think about us versus other platforms, obviously we know the answer, but why us versus REITs? What does that look like?
Yeah.
And do you want, I can handle it? Or
Yeah. I think you have a better answer than I could ever come up with for this.
Yeah. So, I mean, it's this idea of REITs are described, or actually REITs are real estate investment trusts, and they're publicly traded equities a lot of times. Sometimes they're private REITs, but let's go into publicly traded equities.
Yeah.
They have this rule. It's a 75, 75, 90. 75% of their assets have to be in the form of real estate assets. 75% of their income has to be in the form of real estate related activities. So it could be a mortgage or an equity REIT. And then 90% has to be distributed out to REIT stockholders. Now, that income that you receive, that 90% income, it actually is taxable. And so when you receive an income from a REIT and you're saying, oh, this dividend is 10%,
right.
For you, it's actually not 10%.
Right.
Yes, you might put in $100 and get out $10, but when Uncle Sam comes knocking at the end of the year, that $10 is now $5
Right.
in your bank account. But when you look at it from returns of capital, on our perspective, if you invest in real estate, the beauty of it, the reason why these billionaires don't pay taxes is they invest in real estate because there are inherent tax benefits associated with it. And there's something called a depreciation tax shield, which is a ghost tax or a ghost expense that protects you against taxes. And so if you get a 10% yield from us, from that single family rental asset that you're invested in, that 10% at the end of the year, Uncle Sam comes knocking, it remains 10%.
Right.
Because it's protected.
Right.
And I'm not even going to touch on the fact that it could actually look like a passive loss on your tax returns at the end of the year.
And why is that beneficial?
I mean, you can slap that against your REIT income if you want. So use us to benefit your REIT. I mean, REITs can come knocking and say thank you to us all they want, but this is true real estate investing. And so when you look at it from a REIT perspective, it's the tax benefits we pass along that's way better. It's the fact that REITs are kind of vanilla in the sense that they're incentivized with that 10% that they don't have to distribute. That's what they use to capitalize more assets. That's what they use to buy more assets. But their target is just one sort of dividend yield. They don't really care that much about any sort of dynamics in a marketplace. They're like, I want to hit a 5% return, right, and I want to go home and sleep well at night.
Yeah.
That's it.
Yeah.
I mean, could you imagine if that would just suck. And the fact that it's still about it today, the fact that people still invest in these REITs and there's this multi-trillion-dollar industry out there that is investing in REITs and not in private real estate, right, is absolutely astounding to me. And I envision a world where these platforms, where Mogul comes up and all of a sudden these REITs don't have the demand they once did, right, and we start to replace them. And I think that's going to come sooner rather than later. And I think that we're the first one to do it in the residential space in a truly scalable fashion with our inventory partners. So I would just say REITs suck, invest in real estate. That's what I would highlight. So if you're just joining us now, obviously follow us, subscribe us, all the above. So I think we have time for a few more questions. To the extent that you have one, just throw it in the chat. But I think one of the last questions, or I think we can do like 2 to 3 more. Yeah. That sound about right. What 30-second spiel? Mm-hmm. What are the assets you're most excited about on the platform and why?
Up and coming or existing now?
Existing now.
Ooh,
the Kendall, the Roman, the Logan. Bowser's already out. It's already sold out. But the Bowser, the Roman, the Logan, the Kendall. Yeah. Which one?
It's like asking me to pick favorites among children.
But you have them. But you have dogs, favorites. And you have a favorite dog.
Whoa, Jen and Tom, I love you guys equally. So I would say, and don't see this as a cop out, genuinely feel this way. I think there are strengths and weaknesses to each. So
just kidding.
I, as a real estate investor, personally have varying appetites for risk at certain points. And I have great exposure to all 3 of the properties that aren't sold out right now, with Bowser being the 4th that is sold out. I would say that each one has kind of its own strength and weakness within the business plan, right? And then weaknesses, when I say, are just relative. It's just relative to, for example, yields being lower to what the Logan has at, the Roman, for example. That's what I define as a weakness. It's not a true weakness. The
Relatively.
relative.
Yeah.
It's all relative, right? So I just want to make that very clear. But strengths of each one. So highlighting just the quickly, maybe each one again, 30 seconds rule. The Logan, right? Beautiful property, incredible location, truly unique product that I haven't seen in most parts of California. Villa style, massive home, right down the street from where Ashton Kutcher and Mila Kunis got married, which is hilarious. Right in the middle of wine country in the Inland Empire. So plenty of kind of destination, wedding venue, vacation home style renters that'll be out there. Very high yielding, just because we got it at a great basis, off market originally. Created tremendous value day one. That appraisal came back 7% day one above where we bought it. So I think that one, although there's basis on it that provides a lot of value day one from the basis play perspective because we bought it at a discount, that one's going to be really high yielding. It is really high yielding. So that's a strength of that, right? Is like, am I feeling like I want more immediate gratification with my return of capital? Do I want to make that 10% yield up front as opposed to having a larger slice of that pie baked into the appreciation that Alex and I talked through earlier? That's the one I'm going with, right? And sometimes I do feel that when I'm allocating my monthly savings or weekly savings, like I said, I'm feeling like, oh, I kind of want more immediate yield on this. So I'm willing to put, $1,000 in there. So that's a great strength of that one. You have the two others in Texas right now, the Roman and the Kendall, which are relatively similar from both product style and I would say also business plan. Incredible backyards. We're in Texas, right? It's huge yards, pools in both. Also incredible pool hot tub combo at the Roman. I think those are both lakeside, incredible destinations. So much baked in growth in the market. The fundamentals look incredible. Fundamentals also look great in Ukaiba and in Inland Empire, and that's more on the yield side, right, compared to like the comp set if you check that out. But with the Roman and the Kendall, the fundamentals look incredible from a basis perspective and where that basis is going to continue to go. So appreciation is averaging around 5% per year in kind of both of those markets, both those sub-markets as well. And we've seen, if you go check out the calculator and also the market fundamentals on both, the 5-year historical appreciation is just monumental, in the double digits. So I think those are incredible basis plays. If I'm thinking I'm okay locking up my, $2,000, $5,000, $10,000 for a little bit longer of a time period, if I'm going to experience more of that appreciation on the year and truly reap a larger portion of that pie from that levered return, because again, right, a lot of the value, if you can sit and wait long enough, and sometimes even up front, if you get a great basis play like those two, is baked into that appreciation and that return on your capital from a levered perspective. So I think if I'm feeling a little bit more like I'm willing to take relatively, more risk and I want to see a higher return on my capital and I'm willing to lock it up for a little bit longer period with less yield, right, in the interim, relatively less yield, I'll probably go with those. And so I feel that sometimes too. And so, hard to pick a favorite, but they all have incredible strengths. And I think it's really all about what your appetite is. And we're happy to talk you through that. If you have questions about that, you want to schedule a one-on-one session with us, please do. I'm happy to talk through, what kind of your appetite is, why you're feeling what properties are the best, and then you can make that own decision yourself based off of the question that I can answer for you. And Alex too.
Excellent. Yeah, great way to put it. That was a cop out, but I think the Roman and the Kendall I think are incredible assets. I think the Logan's also an incredible asset. I truly do believe in all those, and I'm invested heavily in all those. So I would just caveat with that. That's my disclaimer that I have to put in. But I mean, thank you everyone for joining this week. It was an absolute blast. Obviously, follow us on LinkedIn, YouTube, Insta, whatever it might be. But go look at the properties, go check them out. They're selling out pretty quickly, which is incredible. But I mean, the assets speak for themselves, so it's not too out of left field, I would say. So thank you again for joining, and send in any questions that you might have. We can answer them next week. Subscribe to the YouTube channel if you haven't to get up-to-date notifications of us going live. But with that, thanks, Joey, for joining, and thanks everyone else for joining.